So my name is Jeff Weslow. I'm the Assistant Director here at HI Group for Business Development. Thank you for taking the time to join us and learn a little bit more about the affordable housing market. We hope you walk away with a better understanding and appreciation for this market as an opportunity for you to grow in. You could switch the slide. Just a note regarding HEI Group, we are the leading property and casualty insurance organization founded by and dedicated to public and affordable housing. We are headquartered in Cheshire, Connecticut, and we've been here almost 40 years. During that time, we have delivered solutions to protect assets, improve efficiency, empower employees, and advance housing strategies. Just a note, moving your mouse across the bottom of the screen brings up your options to access the chat and the Q&A. The chat we'll use primarily for housekeeping notes, and the Q&A we'll use to ask any questions. So you'll see the questions and the answers posted in the Q&A. So taking a look at today's agenda, we want to provide you with some characteristics of affordable housing. Define it. Why we feel this is an opportunity. Public housing is distinct, and how does it differ? Where does the funding and guidance come from to make affordable housing work? And then how you might expand your knowledge of this book of business. We'll give you a few resources. So who will you see or hear from today? Kelly McElwain is our Director of Research, and she'll be the primary lead and speaker for our session today. Kristina Tatroe is our Director of the Housing Training Institute, and she'll give us an overview of the resources available from HTI. I represent our business development team. Both my team members, John Welch and John Fitzgerald, who you can see hopefully at the top of your screen, are on and listening in and may participate depending on the circumstances. So let's get the content of our webinar in front of you, and I'm going to hand it off to Kelly.
Thanks, Jeff. So, for many insurance professionals, affordable housing can seem complex with its unique financing structures, all the government programs, and industry jargon. Yet, it has also become one of the most resilient and rapidly expanding areas of the housing market. And this creates opportunities for developers, property managers, and the professionals who support them. So I'm going to start with a simple question that doesn't always have a simple answer, and that is, what is affordable housing? While the term is widely used, it can mean different things to different people and organizations. At its most basic level, housing is considered affordable when a household spends no more than 30% of their income on housing costs. And because incomes vary, affordability varies too. Family earning $40,000 can afford a much lower rent than a family earning $80,000. However, in many communities, the cost of building and operating housing is too high to offer the rents that lower income households in particular can afford. So, to bridge that gap, governments often provide financial assistance that makes affordable housing development and operations financially feasible. The term affordable housing typically refers to housing that receives some type of financial support from the government in exchange for keeping rents affordable to low-income households. And that support can come in many forms, including tax credits, grants, low interest loans, and rental assistance. And in exchange, property owners agree to meet affordability requirements and follow other program rules. And it's worth noting that some housing could be affordable without government assistance. You may hear of this referred to as naturally occurring affordable housing, or NOAA. And these are typically older or lower cost properties whose rents remain affordable because of the market conditions rather than government funding. And while NOAA plays an important role in the housing market, today's discussion is going to focus primarily on properties that receive government subsidies to maintain affordability. So now I'd like to hear from you all. Please use the polls in the webinar. We'd love to see whether any of your clients manage affordable housing. We'll give folks a couple seconds to respond. We just want to get a sense of everyone's involvement in this space. I'm sure we have a good mix of folks here today. So give you all a couple more seconds to respond. And we think that this webinar will be really helpful for folks that are new to the space as well as those seasoned professionals. So it looks like most of you we do have clients that manage affordable housing, which is great. So you may have some general understanding of some of the terms that we'll be hearing today. And there's a few of you that do not, which great. We welcome you and to this journey and hope that it'll take a lot away as you grow into this market. And for those of you that aren't sure, we'll close with some resources that might help you discover how much affordable housing is in your community and clientele that you're serving. So there are dozens of affordable housing programs that each have their own rules for determining who qualifies and the conditions that property owners must meet. Some of these programs support the construction of housing, while others support the long-term operating costs. The income thresholds for each program can vary, but typically they target households earning below 80% of the area median income. Some programs rather, also require that property owners target specific populations like older adults or people with disabilities. And to give you a little bit of context on the history of these programs, early on, most affordable housing was built and owned by the government. In the 1930s, the government began funding housing authorities to build public housing. However, by the 1980s, construction of new public housing had begun to slow. However, beginning in the 1960s, new programs were created that incentivized both for-profit and nonprofit organizations to build and operate affordable housing, generally using a public-private partnership model. And today, most affordable housing is built and preserved this way through the Low-Income Housing Tax Credit Program, also known as LIHTC is the acronym, or it's spelled out LIHTC, but pronounced LIHTC. And since it started in 1986, LIHTC has funded 3.7 million affordable homes. And some of these units have received multiple rounds of funding. And of those, about 2.7 million are currently affordable today. One of the reasons that affordable housing may feel really complicated is because developments often rely on multiple funding sources, and there's a lot of different programs that can finance these properties. This slide includes many of the common federally funded housing programs that help make these properties affordable. The key takeaway isn't memorizing every single one of these programs, but it's understanding that affordable housing is often financed through multiple funding streams, which means additional oversight, requirements, and stakeholders that can vary depending on how it's financed. And understanding these layers can help explain why affordable housing transactions often involve many partners and specialized expertise. So now that we've level set what affordable housing is, I want to pivot to discuss why it represents a business opportunity. The combination of strong demand, substantial public investment, and a proven operating model has made affordable housing an attractive and growing segment of the multifamily housing industry. The need for affordable housing, first and foremost, has reached record highs. In 2024, a record 22.7 million renters spent more than 30% of their income on housing costs, and this has increased over the years. Housing affordability challenges are the most acute for the lowest income. Across the political spectrum, though, most Americans realize that housing affordability is a challenge in their communities and support government intervention to help make homes more affordable. At least 3 out of 4 people believe that there should be more policies to make housing more affordable. And the majority of Americans support investing in distressed neighborhoods and making it easier to build homes in their community. And this widespread support continues to enhance opportunities for affordable housing providers. As a result of both the growing need and interest, state, local, and federal governments have invested heavily in the development and preservation of affordable housing. While many social service programs have faced funding cuts, funding for affordable housing has actually grown in some instances, as we see here. Um, for instance, the One Big Beautiful Bill Act permanently increased funding for the low-income housing tax credit program, and it also included several provisions that are projected to support the creation of 1.2 million affordable rental homes over the next decade. And these funds are distributed by state population, meaning the impacts of these investments should be felt across the country. Congress is also taking steps to support future development by making policy changes that aim to remove administrative barriers and expand access to capital. The recently enacted 21st Century Road to Housing Act includes several provisions that could support affordable housing construction. For instance, the law aims to streamline some environmental review requirements, enables community development block grant funds to be used to pay for affordable housing constructions, and permits banks to invest more in affordable housing. Complementing these investments, states and cities issued a record $21.7 billion in multifamily private activity bonds in 2023 to both build and preserve affordable properties, demonstrating that this investment is also happening locally as well. And this has supported growth in the affordable housing market. Since 2010, more than 843,000 affordable housing units have been built or recapitalized using the LIHTC program. And Yardi Matrix estimates that roughly 78,000 affordable housing units were completed in 2025 alone, which builds off of substantial growth. And looking ahead, nearly 238,000 fully affordable units are projected to be complete over the next 3 years. And while multifamily completions are expected to moderate a bit at levels in line with 2019 and 2022 growth, fully and partially affordable units are expected to comprise a greater share of these units. Nationwide, there are currently 5.1 million federally assisted rental homes across about 80,000 properties. And as you can see, LIHTC is responsible for funding most of these units, followed by another program, Section 8 Project-Based Rental Assistance. And our federally assisted housing insights dashboard can help you quantify how much affordable housing is in the states or counties that your organization might be targeting. And one of the common misconceptions that we'll see about affordable housing is that these properties are inherently riskier than conventional multifamily housing. However, the data can share a different story. Research shows that most affordable housing is in good condition and offers housing quality that is comparable to the broader rental market. Nearly 90% of HUD-assisted households live in housing that meets adequacy standards. And complementing this, the Department of Housing and Urban Development enforces strict safety and quality requirements, mandating regular inspections to ensure properties remain well maintained. Occupancy rates for properties funded by LIHTC are also exceptionally strong. The median LIHTC property maintained a 97% occupancy rate through 2024. And this was not an outlier. As you can see, this has remained relatively high since 2010. Comparatively, the overall occupancy rate for the average rental was much lower in comparison. Affordable properties have also maintained exceptionally low foreclosure rates. Since the program began, LIHTC properties have experienced a cumulative foreclosure rate of only 0.47%. And this is substantially lower than the delinquency rate for the multifamily housing market overall. So why does this sector perform so well? Several factors contribute, including strong demand for affordable housing, oversight from investors and housing finance agencies, and compliance monitoring. State housing finance agencies establish selection criteria and monitor tax credit properties for compliance after these properties are constructed. Their selection criteria are established annually in their qualified allocation plans, which allows them to respond to local housing needs and challenges. LIHTC properties also receive significant funding from institutional investors due to the program's public-private partnership model. And since these tax credits can be reclaimed by the IRS if the property is out of compliance, investors typically screen properties extensively before development and monitor them after construction, generally beyond what state housing finance agencies may require. And if a property is in financial trouble, investors could step in to help the property out before it reaches foreclosure to protect their investment. And for insurance professionals, this stability is important as part of the affordable housing value proposition, in addition to the value that it brings to the families and communities that it serves. So now I wanted to explain a bit about some of the differences among properties and the residents that are served across the affordable housing landscape. Affordable housing and public housing may often be grouped together, but they are not the same thing. And several differences emerge when we compare these two programs. Affordable housing can differ from public housing in many ways, including their funding structure, their ownership structures, regulatory requirements, even the resident population, which is tied to the requirements of the program, the histories of the programs, and all of these factors together can impact who lives in these properties, where they're located, how they're built, and the funding available to them. One difference that we see is that there are different income targeting requirements across the programs. And as a result, public housing properties tend to serve families with lower incomes and greater needs. Public housing residents pay 30% of their income towards rent, while LIHTC households generally pay rent that is affordable to families earning either 50 or 60% of the area median income. Public housing properties also more commonly support children and members with disability when we compare resident demographics. Affordable housing also tends to be newer than public housing. While 4 and 5 public housing units were initially funded before 1980, 63% of LIHTC assisted units were recently funded 2000 or later, as you can see here. Geographically, affordable housing is also more dispersed across the country. This map displays the number of LIHTC assisted units by metro area. And the areas in black have more than 10,000 LIHTC assisted units, and they're scattered across metro areas across the country. Meanwhile, public housing tends to be concentrated in those older industrial cities, particularly in the Northeast and Midwest. Public housing also tends to be concentrated in fewer metro areas as well. When we look at the top metro areas for each program, we see that 49 metro areas have at least 2,500 public housing units, while 140 metro areas have at least 2,500 LIHTC units. New York has the most public and affordable housing units. Other top metro areas for affordable housing are Los Angeles, Washington, D.C., and Houston. And for public housing, the biggest cities with older industrial ones in the Northeast and Midwest include Chicago, Boston, and Philadelphia. So now that we've talked a little bit about the opportunity to grow with affordable housing and how it differs, how affordable housing might differ from public housing, I'd love to get a gauge of your current knowledge of the affordable housing industry. We're going to continue the discussion with some program-specific insight on the low-income housing tax credit program, as it's the largest program responsible for building and preserving new affordable housing today. And but let's see, are people feel very knowledgeable, a moderate understanding, a basic understanding? And if you follow any industry publications, newsletters, or have resources that you've found helpful, if you feel that you're very confident, I encourage you to drop those recommendations in the chat as well. Let's see. So we have a good mix here. There's about 22% of you that are very knowledgeable. Most have a moderate understanding. Some have a basic understanding. And again, we have about 10% that are new to affordable housing. So welcome. And hopefully we can all learn a bit from each other. For those of you that have been in the industry for a while, again, I encourage you to drop some recommendations for the folks that are new here. HAI Group has a ton of resources which we can talk about at the conclusion of the webinar as well. Thank you. So now that we've introduced what affordable housing is and how it differs from public housing, I want to spend some time to give you a background on how these properties are financed. So affordable housing funded by LIHTC includes several players, and this chart breaks down each player's role. The IRS allocates tax credits to state housing finance agencies, which I can also refer to as HFAs. And these HFAs then establish qualified allocation plans, and this dictates how they will evaluate and award tax credits based on their priorities and selection criteria. And they establish these plans annually. These plans can require or incentivize developers to build in certain areas, target specific populations, and even include certain building design features. For instance, as of 2022, 32 states considered climate hazards when awarding their tax credits. And this could include water conservation, wildfire protection, flood mitigation, and storm protection. While standards vary by state, they can range from limiting development in certain areas like flood zones or requiring property owners to install fire retardant window coverings. Owners and developers then compete for these tax credits by submitting their applications, which are then reviewed by housing finance agencies to determine who should be awarded the credits. Affordable housing developers can also apply for funding from other sources, whether it be lenders, local funds, to fill any gaps. And each of these lenders and funders can then impose additional requirements that influence how the property is developed. And once a tax credit is awarded, the affordable housing owner or developer often sells it to an equity investor and forms a limited liability company. And since affordable housing owners generally do not have sufficient income to claim the tax credit, equity investors provide the upfront capital to fund the construction of the property in exchange for an ownership stake and the ability to claim that tax credit over the next 10 years. And syndicators can help developers find an equity investor, and then their partners, like attorneys and brokers and insurance professionals, help them with finalizing all of these deals. And once the property is built, the Housing Finance Agency monitors the property for compliance with state and federal rules. So there are two types of tax credits in the low-income housing tax credit program. The most competitive to receive are 9% tax credits, which cover up to 70% of development costs. And on the other hand, 4% tax credits are awarded on a rolling basis. However, they only cover 30% of development costs. And since tax credits only cover a portion of those development costs, these properties often receive supplemental funding from other programs. Private activity bonds are commonly awarded to fill the financing gap, particularly for 4% tax credits. And at a minimum, affordable housing properties require coverage that is similar to any multifamily property. However, affordable housing properties may also be required to meet additional requirements imposed either by the government, its funders, equity investors, or their local communities. For instance, lenders may require extensive coverage, often including builder's risk, commercial general liability, umbrella liability, boiler and machinery, automobile, and other coverages depending on the property's location and unique risks. And for insurance professionals, one of the most important lessons is to encourage your clients to contact you early. Developers and property owners are recommended to contact their insurance professional as soon as they have an idea for the project that they're looking to build to ensure that the insurance requirements are tailored to that property's needs. And ensuring that affordable housing providers meet with their carrier before signing a contract can help streamline the insurance process, anticipate long-term obligations, and ensure compliance with loan requirements. Starting early can also help developers avoid last-minute roadblocks when securing coverages and presenting documentation to lenders. Before we share a few final resources and move to Q&A, we'd love to hear from you all about which topics you would be most interested in learning more about from today's session. Your feedback will help us shape future resources around either blogs, trainings, webinars that would be most beneficial to you all to grow in this space. Some ideas include affordable housing programs and funding, insurance requirements and coverage, risk management and best practices, compliance and regulations. Some of these are already covered on HAI Group's Resource Center, which I'd be happy to point you to. And if there's something that's not listed here, I encourage you to enter those ideas into the chat on other topics that you'd be interested in learning more about. Give everyone another second or two. Someone said all of the above. That was a good observation. We'll have to include that next time. So it looks like insurance requirements and coverage is a top interest, unsurprising given the audience that we have here. Others include market trends and opportunities, compliance and regulations, affordable housing programs and funding, and then some risk management best practices. So really good feedback. We'll definitely take that back with us, and we'll definitely share some of the existing resources that we have in these areas for all of you. So if you're interested in growing with this market, understanding local opportunities and financing programs is essential. So before we wrap up, I just wanted to highlight a few resources that can help you with this. One tool that can help you understand the affordable housing stock in your area is the National Housing Preservation Database. This resource can help you locate properties in your target market to assess each property's funding characteristics as well as its location characteristics. And this can be helpful for you to understand its history, when it was last funded, as well as the regulations which might apply to that property. You can find this data at preservationdatabase.org. And one action item you can take away, especially for someone that's new and learning about this industry, is to spend a couple minutes exploring your territory in the NHPD. You might be surprised at how many affordable housing properties already exist in your market or region. All right. So, as I've alluded to, affordable housing is a really specialized field, so training really matters. And to help you learn about some training options with your professional development, I'm going to pass it off to Kristina Tatroe, the director of the Housing Training Institute.
Thank you, Kelly. I appreciate that. Hi, everybody. I'm going to tell you a little bit more about our award-winning Housing Training Institute. So at HAI Group, we help affordable housing organizations protect what matters most. And housing is all we do. We're focused on housing. So for decades, we've offered online training and professional development built specifically for affordable housing professionals. Our accredited Housing Training Institute specializes in self-paced, on-demand courses and industry-recognized certifications in collaboration with trusted partners like Baker Tilly, Nan McKay, and the Consortium for Housing and Asset Management, CHAM. We focus on enhancing the performance of housing professionals by offering effective, engaging training on a learning platform built for flexibility. So they can learn at their own pace, they can pause, replay, and revisit content anytime. And now we're actually offering a hybrid learning approach for one of our most popular certification courses, the CHAM Asset Management Specialist Certification. This hybrid learning opportunity combines the flexibility and accessibility of the self-paced training with live facilitator-led sessions and offers peer-to-peer learning and networking opportunities within a learning community. And they love it. Organizations continue to rely on us for housing-specific learning tracks, such as new employee onboarding, LIHTC, which you heard a lot about today, and compliance courses. There are several annual subscription options available to choose from based on learning goals, bringing access to over 135 courses to an entire organization with subscriber-only discounts on our certification courses. So please feel free to contact online training at haigroup.com to learn more, and you can even schedule a demo of our learning platform.
I'm going to take it from here, and we'll be answering your questions that you've posted in the Q&A in the chat, and we're willing to take some more questions. But first, a poll, true or false, and this is about our ability as an organization that provides insurance. True or false, HI Group can insure portfolios that include both affordable and market rate units. So a lot of people see us as an affordable housing provider. Is that all we do in terms of the housing we provide coverage for? Take a second, let us know what you think. So it looks like this is a very well-educated group of people with regard to how they see HI Group. It's true. We can insure portfolios that include both affordable and market rate units. And it is our mission to provide to public and affordable housing, but we can insure portfolios that contain up to 80% market rate housing. So if you're a provider and you've got market rate housing, send us all the portfolio. We'd love to take a look at it. Somewhat related, but a common scenario today, or maybe it's unrelated, but a lot of the buildings that we see that have affordable housing in them also have businesses operating on the lower floor, the first floor of the building, lessors risks. So if those are part of the portfolio as well, we'd love to take a look at those. Those are taken a look at on an individual case-by-case basis. So that is possible as well in terms of your entire portfolio. So if you go ahead to the next slide. So from our standpoint, while Kelly went into a lot of the details with regard to what is public housing, what is affordable housing, how they differ in terms of their funding and how they're managed, we have three buckets that we provide our organizations into when we provide insurance coverage. From a affordable housing standpoint, we have an insurance carrier known as Housing Enterprise Insurance Company, HEIC, commonly called HIKE. And all our affordable typically goes into that organization. Our public housing that we insure is put into two other organizations, HAPPY, the Housing Authority Property Insurance Company, and PAHRC, the General Liability Company, or the Housing Authority Risk Retention Group. We differ a little from the conventional carrier who can put an entire portfolio into a single company. We break it up depending on the type of housing it actually is. If we go to the next slide. So hopefully Kelly and her content and Kristina with her content, and you've had some time to think about some of the information that that was presented maybe at the beginning. Do you have any questions? What questions can or what are just you're interested in hearing about being answered?
So there's one that came in, and that is, what flexibility do you have for underwriting multiple locations in one policy?
So it depends on a couple things. We can accommodate multiple locations and multiple states. We do evaluate accounts and their locations on a case-by-case basis. It depends on ownership, depends on the states, but that is something that we can accommodate.
Another that came in is whether you have eligible opportunity. Wait, do eligible opportunities need to be HUD certified is another question that came in from.
HUD certified. That's an interesting question. Kelly, I don't know, is there such thing as HUD certified properties? I would imagine the funding itself determines whether it's funded or supported by HUD, but is it actually certified? Is that a term that's used?
I'd have to look into it. I know that there's other agencies that can fund affordable housing, USDA being one of them. And I think maybe you could speak to the various agencies that fund affordable housing and whether they're potentially eligible for coverage through one of HEI Group's products or services.
So an organization like the USDA does fund the construction, and then they also fund the residents themselves from two separate funding sources. They are eligible. There's things or entities like development authorities that are eligible. Their funding is also supported by various federal and state programs. So the individual program, if it's subsidized in some way, it's more than likely a candidate for something that we can take a look at and define as affordable housing and put it into our program.
Great. Another question is HEI Group a brokerage or a carrier? And do we need to contract to work with you?
So, are we insurer or a brokerage, I guess, is the first question, right? Or first part of that question.
Yeah.
So HEI Group has three insurance companies, so we are a carrier. Uh, if you're a housing authority, we can act on your behalf and place business. Otherwise, our affordable housing, we rely on the agents that we work with. From the standpoint of the second question was a contract. So we do appoint agents so that they can sell our product or place our product with us. And so you need to get appointed if you're an agent before placing a piece of business with us. And we can work with you, the business development team, the underwriting team, our licensing and product team can work with you to get you an appointment depending on the submission that you're providing to us and the business you provide to us.
Thank you for answering that. I see that there's a couple of folks that entered questions into the webinar chat. I just like to take this moment to encourage everyone to enter those into the question and answer pane. And if you don't see it, you can click the ellipsis and it might appear there. Thank you. So we have a couple more questions that are here. And one is, can you provide blanket insurance for a 100% affordable housing development containing over 100 buildings and 400 units?
We would have to take a look at the submission. The characteristics of the portfolio are really what determine our ability to underwrite a piece of business. So, if you've got that information handy, reach out to us, and we'll give you the information to reach out to us at the end of this session, and we'd love to have a conversation with you and go further into evaluating that portfolio.
Great, thank you. Another question is, how much does this change state to state, or is it cookie cutter and is it all the same for states? Is another question that we've received.
So we are licensed in the lower 48 states, and each state, if you're not aware of it, and I imagine most of you would be, each one is licensed or regulated differently. So we have different requirements that we meet in each state. So we would have to see what you have to take a look. It's very customized actually in terms of the evaluation and how we work with you in terms of the submission evaluation.
Another question is, what is the current appetite for general liability and excess liability without exclusions or sublimits for assault, battery, firearms, and abuse?
So for those of you who are keep in tune with the insurance market, you realize that we are in a soft market. And so the restrictions, coverages, deductibles have all been changing, becoming much more generous, if you will, over the last year or two. So those kind of things are specific to carrier, specific to region, and we'd have to take a look at what you have in terms of really giving you an affirmative answer in terms of what's available and what we can do with regard to providing coverage on those areas.
Another is, are there any solutions for assault and battery with hike?
We're always we're looking for ways to work with our customers and our regulators in terms of providing the necessary coverages. It varies by location, and it's it's something that we have to look at on a case-by-case basis.
Great. And then there are a couple more questions. Trying to also check the chat here as well. Um, who can we contact to talk about opportunities and appointment model?
So, as mentioned a little earlier, we have a email address, newbusiness@haigroup.com. And if you send your request or information to us there, we will work with you on that, on answering that.
I just moved to that slide with the new business email for anyone that wants some follow-up information there.
Yeah, you'll get a copy. I see some of the people have asked in the chat whether or not they'll get a copy of the slides, and you will. So you'll have this information if you want to just wait till you get a copy of the slides.
Great, thank you. Let's see. Seeing there's some more questions coming in. Oh, thank you for adding the email. And another question is, what is the commission structure for new business and renewal accounts?
Our commission structure is the same across new and renewal, and it's 15% for agents.
And then as a follow-up, is there a contingency bonus that's offered to agencies?
We don't have anything like that structured with our programs.
And then another question is, do you manage claims in-house or is a TPA utilized?
No, all our claims are managed in-house, and actually we take great pride in our claims department. They have gotten quite a bit of kudos from our customers with regard to their handling and addressing the claims quickly and succinctly, and doing a great job on those. So yes, we have our own in-house group of claims folks.
And then another is, do you see a future where you will appoint independent insurance agents for HAPI or HARG public housing policies?
Yes, that's an eternal question, I guess you could say. It comes up quite often, and all I can say is today, no. Tomorrow, who knows? Things change. You have to adapt to the market, but whether or not that will change, I couldn't tell you. I don't think we have any discussions around making that an option, so to speak, at least at this point in time. See anything else there, Kelly?
I don't see any questions right now. I encourage anyone that has any burning questions to put them in the chat. And certainly, if there are follow-up questions following the webinar, you can contact any one of us for more information. And we'll also be circulating a copy of the recording as well as the slides from everyone that registered to attend today's session.
Yeah, if you just pop up one slide, Kelly, you can display your information and contact information and Chris's for those folks who want it right away. I wanted to thank both of you, Kelly and Kristina, for participating today. Really appreciate the support and explaining both the types of housing, affordable and public housing, as well as providing us with some resources for learning more about affordable housing.
Our pleasure.
My pleasure.
And then I just wanted to say thanks to everybody who spent the last hour or so, or less than an hour, I guess, with us. And we'd love to hear from you. If you have any questions or certainly submissions, we hope to work with you in the future. I see John and John have come on with their video camera. So these are the folks that we work together, business development, to bring in business, and we'd love to work with you. So we hope to see you in the future.